Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician, also Portfolio Manager. Thank you so much for giving us a few minutes of your time where we're going to talk about some of the highlights from this week's investment allocation meeting. We're going to talk about, about we do every week, something from the Fed. In this case, what we call the pre-announcement, and I'll explain what we mean by that from the FOMC. The rent factor that plays into inflation and how that might impact things going forward. Andrew's going to pick up a technical note and look at the indices and how they compare to the last time the market bottomed out back in June. And then we'll look at where we are election cycle as we head in here right down to the wire in terms of election races. So we'll start with that FOMC pre-announcement. So here in the early part of November, we will have the next set of Fed decision. Where they will likely raise interest rates. In fact, we know that's likely because they have gotten in the practice of essentially pre-announcing their policy through the Wall Street Journal. They have found that to be the most palatable way to kind of get the market prepared for what they're going to do. Prior to that meeting, there was some speculation that they might go a full 1% increase because all the inflation that we've had, all the inflation data that we've had has been unrelenting and continuing to point north. Well, they sort of settled that through the Wall Street Journal. Of course, they still could, surprise, they still have the right to change things, but practice would indicate that they are ready to go 0.75%, 3/4 of a point in this meeting. Maybe also as a part of that pre-announcement, what is interesting is that several of the Fed members are beginning to publicly announce that they would like them to slow down. And that is a change because up to this point, there has been strong unification that they would be very aggressive and focus on nothing but inflation. So we do see the first signs of them beginning to want to, what the words they're using now are, take a step down in the rate of increase. So it's possible that after we get this 3/4 of a point, they go down to a 1/2 point or something like that. We'll find out more in the week, but the market certainly loved that. They have been waiting for any sort of indication there would be a slow in the pace of interest rate increases. I will note that this is something that we talked about on Monday in great detail. Back in June and July in the summer, the market also got sort of hopes that the Fed would back off and go slow. And we were told that the market was way ahead of itself. So we will see. But either way, the 2-year notes here is the chart we're looking at. And the yield came down quite a bit on Friday. And that helped to ease concerns. It helped spark a rally that we saw in stocks and other risk assets. One of those key factors is in this next chart, which is the rent factor. So all of what the Fed actually does, at least for now, is all focused on inflation. That is their job, to tame that. This may be one of the things that is fueling those that have a dovish perspective or not wanting to raise interest rates enough. And that is a forward-looking look at inflation. By far, the biggest weighting into the CPI is housing. And what we see is, or how that is calculated, is on a steep lag. There's about an 8-month difference between when we see data turn and when it shows up in the CPI. And so if we look at 3 different private market metrics and cast them forward on an 8-month basis and plot that against CPI, which is the red line here, we can see that they are forecasting that the CPI at least begins to stop increasing and perhaps turns down in the months ahead. So if that were the case, that would give the Fed a little bit of cover to slow down. We shall see. Of course, all the other elements continue to go straight north. So we need some sort of evidence, and I'm sure they will need some sort of evidence to follow through on that slowdown. So all eyes will be on that meeting in the coming week. For now, the market is taking a cue and rebounding, and we will see how that goes. We'll turn our attention now to Andrew and get an update on the technical look of the indices.
Yeah, so covering the Fed, covering bonds. Now we'll start looking at some equity charts. The first one we want to show you is we typically break the market down from a broad perspective into 3 groups. We look at the S&P 500, the very common index that we often are always talking about, the largest 500 companies in the U.S. Then in the very bottom of this channel, we have an equal weighted S&P 500. So the cap weighted version, the general one we're always talking about, It's each weighting is based off the size of the company, based off their market capitalization. That gives a very large weighting to the Googles, Amazons, Apple, Microsofts of the world. Just those stocks alone account for a large share of the market. If we were just to give all the companies, all the stocks an equal weighting, that's what gives us that bottom panel. And then right in the middle, we have those big guys, the FANG groups, the Facebook, Apple, Amazon, Microsoft, and Google. Because there's such a large weighting, we want to track how they're moving, because it's kind of the tail that wags the dog, to where if those stocks start to really perform strongly, then we often see the market follow along. And just the opposite happened during like the summer months or earlier in the year. When those stocks begin to struggle, the market often will follow it lower as well. So what we're seeing here is we're getting a nice rebound across the equal weighted version and the cap weighted version of the S&P, recovering those June lows, which we can see with those green horizontal lines. And we are seeing the largest companies as well, right back, finished it last week, right back at those June levels. Why this is important is this week, we're right in the middle of earnings season. We had about 20% of the stocks report coming into this week, and we have all of those big mega cap names, again, Apple, Amazon, Microsoft, Google, they're all reporting this week. So we're going to really be able to see, how does the market handle? Are they get some good earnings? Do we start seeing those trends continue higher? Because if we're going to see any type of uptrends, we need to see step-by-step lower, higher lows, higher highs, and starting to see the formation of a new uptrend form across the different sizes of the stocks, the equal weighted version, the cap weighted version, and then of course the ones that make up a huge chunk of the market, about 20% of the S&P, those FANG names. And so the fact they're all reporting earnings this week means we're really going to see either a boom or bust by the close on Friday. Now, another positive market catalyst, or potentially so, is when we start looking at different market cycles. So the market typically will trade just like the seasons do, with different strong periods of the year and weak periods of the year. And we can also look more broadly and look at how different entire years perform by the election cycle. Now, this has nothing to do with who's actually going to win the election, midterm election. It doesn't matter. It doesn't have a favor for Democrats, Republicans. It's not political. It just looks at historically, the market does have certain trends during different parts of that 4-year cycle. And what we can see here is the black line is going all the way back to 1927, so the last 123 years, and looking at the average trend for election year, the post-election year, mid-election year, which what we're in right now, and then it overlays our current trading year in red for 2022, as you can see there on the chart. And you can see we pretty much have done a pretty good job of following that seasonal pattern. We saw some weakness early on in the year, and traditionally, based off the election cycle, that we should start seeing a low in the fourth quarter. Fourth quarter has historically been the strongest part of a mid-election year, and typically start seeing a low around late October, early November. And typically we do see November is one of the strongest months of the year, and December also has been a pretty good year for equity markets. We'll see if this year continues to follow that trend. We have our fingers crossed that it does. This is a piece, one of the good questions we got asked on Monday from our advisor team is, how important is cycles? And the way we answered that was, it's a secondary piece of information, meaning it's not one of our primary inputs for our models like the risk barometer, but it is something we want to pay attention to and recognize. And if we're kind of sitting on the fence with some of our primary data, seasonality can help us maybe go one way or the other. But seasonally, we are entering now one of the more bullish periods of the year, and hopefully we see that get respected in the market this year, because we could definitely start using some more uptrends after some of the rough periods we've had earlier on in the year.
Yeah, well done. And I like this series of, market has a lot of work to do, but we've been waiting months for some sort of positive direction, and we have at least some initial building blocks, and hopefully we can keep that momentum going. Hey, thank you all for sticking with us and giving us this time. Please don't forget to come in and see us. If you need a second look at your portfolio, we don't have the pleasure of working with you yet, please give us a call, 800-928-4001. Won't cost you anything for a first complimentary meeting. Of course, you can scan the QR code if you're tech savvy and get it booked online that way. Hey, thank you again and have a great weekend.